Usually when you try to figure out what's going on outside, you just look out the window.
Right. You just check if it's raining.
Exactly. If it's raining, you grab an umbrella.
Yeah.
If it's sunny, you grab sunglasses.
Yeah.
It's an observable physical reality.
Yeah, it's straightforward.
But imagine trying to predict the weather purely by looking at what people on social media are wearing.
Oh, that sounds like a nightmare.
It is. You log onto your feed, right? And everyone is suddenly taking selfies in these heavy winter parkas, screaming in all caps about a massive blizzard.
So you panic.
Right. You panic, you put on your own snow gear, but then you actually step outside and the thermometer says it's like 75 degrees and sunny.
Yeah.
Relying entirely on the crowd's noise is just confusing, stressful, and honestly a great way to end up sweating in a parka on a beautiful afternoon.
Which honestly perfectly encapsulates the experience of trying to understand cryptocurrency markets.
Totally.
I mean, you have the loudest, most emotionally driven social media environment on the planet, right? And it's running completely parallel to the quiet structural realities of the underlying technology.
So true. Well, welcome to the deep dive. We have a really highly specific, fascinating mission today.
Yeah, it's a good one.
We are looking to decrypt that weird, often contradictory relationship between a crypto asset's loud social media sentiment and its actual market performance.
Which is so crucial for anyone looking at this space.
Exactly. And for a beginner trying to wrap their head around how this industry actually functions, we have the ultimate case study today.
We really do.
We are pouring through a massive stack of June 2026 market reports, on-chain data analytics, and social sentiment trackers focused entirely on one asset.
Avalanche.
Yes, Avalanche.
Okay.
Know by its ticker, AVX. The goal is to help you figure out how to weigh the noisy vibe of retail day traders against the quiet, multi-billion-dollar moves of major financial institutions.
Deciphering that disconnect is, it's arguably the most important skill an investor can develop.
For sure.
Because the data we are looking at paints two completely opposing pictures of the exact same network.
Right. So to understand why this disconnect exists, we have to start with the noise. We need to look at what the crowd is screaming about right now.
And it is loud out there.
Oh, it's deafening. Currently, the retail market is experiencing an absolute bloodbath.
Yeah, it's been rough.
If we look at the historical charts in our sources, Avalanche's recent price action has been just brutal. It fell from a September 2025 high of around $35, right?
Yeah, around 35.28, depending on the tracker.
Right. And it completely broke through critical support levels in the $8 to $11 range.
Just crashed right through them.
Crashed all the way down to recent lows near $5.94.
Which is a massive drop. But, the broader macroeconomic environment is dragging everything down in this massive liquidity reset.
Right. It's not just AVX.
No, not at all. Analysts are tracking negative capital flows out of the major Bitcoin and Ethereum ETFs. That's draining liquidity from the entire sector.
So there's just less money floating around overall.
Exactly. And when we look at the overarching market psychology, the fear and greed index, which basically measures investor sentiment across the space, is sitting at a 14.
A 14 out of 100.
Yes, out of 100. That is an official classification of extreme fear.
Wow. And, throwing gasoline on that macroeconomic fire was a highly publicized disaster on the NASDAQ recently.
Well, right, the AVAT debut.
Yeah, a company called AVAT, which holds Avalanche in its corporate treasury, had its public debut and immediately crashed 38% on the first day.
Which is just awful timing.
Terrible timing. Retail investors saw a traditional stock closely tied to the network plummet, and that triggered a massive wave of panic selling.
Which naturally spilled over into social media. I mean, when the price drops, human nature demands a narrative to explain it.
We need someone to blame.
Exactly. People search for a fundamental reason to justify their fear.
And the narrative they landed on, if you browse Reddit or X right now, is hyper-focused on developer headcounts.
Yeah, I saw that.
The community is obsessed with this one specific metric. Our reports show that a rival blockchain, Solana, currently boasts 795 full-time developers.
Okay.
Sui has 202. Meanwhile, Avalanche is trailing behind with 168.
Right.
The overwhelming sentiment from the retail crowd is that developers are abandoning ship, meaning the network is essentially dying.
Well, retail traders often fixate on highly visible, easily digestible metrics like a developer headcount.
Because it's easy to count.
Precisely. It's a simple number they can compare side by side. It feels like tangible evidence to them.
But it feels like a trap to me. I mean, Judging a massive global software network purely by how many people are writing code for it on a given Tuesday is, it's like judging a restaurant's success purely by counting the number of chefs in the kitchen.
That's a great analogy.
Right, you're completely ignoring the quality of the food or how many tables are actually booked for the night. Is simply counting developers actually a reliable metric of network health?
It's heavily flawed. I mean, a single highly skilled engineering team building a hyper-efficient piece of enterprise infrastructure is far more valuable than 100 amateur developers launching useless meme coins.
Yeah, quality over quantity.
Exactly. But nuance doesn't trend on social media. When the crowd fixates on a lagging metric like this, it creates a powerful feedback loop of FUD.
FUD being fear, uncertainty, and doubt.
Right. And that FUD cycle just feeds itself.
Yeah, the fear drives the short-term price down, which makes people panic more, which drives the price down even further.
Exactly.
But while retail is panicking about the number of chefs in the kitchen, elite market analytics firms are pointing to a completely different reality.
Yeah, the institutional side.
I was reading through this data from the analytics platform Sentiment, and they highlight a massive contrarian twist.
Which is fascinating.
It really is. Their data indicates that extreme negative social sentiment, this exact type of extreme FUD we are seeing, is historically a highly reliable, bullish leading indicator.
The underlying mechanics of contrarian investing are so interesting here. When discussions on social media become overwhelmingly focused on risks and weaknesses, the market actually becomes highly vulnerable to sharp upward reversals.
Let's break down the mechanics of why that actually happens. It basically comes down to exhausting the supply of sellers.
So
right?
seller exhaustion.
So if everyone who is susceptible to panic has already panicked and dumped their tokens, the market is wiped clean of weak hands.
Right, they're gone.
There is literally no one left to hit the sell button.
The selling pressure completely evaporates, and we can physically see this exhaustion in the technical indicators.
Like the RSI.
Exactly. The Relative Strength Index, or RSI, is a momentum tracker. It measures the speed and magnitude of recent price changes.
Okay, so how low did it go?
On the daily time frame, Avalanche's RSI dipped into the 28 to 32 range. Historically, in market cycles, any RSI reading below 30 is classified as technically oversold.
So it's like a rubber band that's been stretched to its absolute limit.
Precisely. The downward momentum has stretched as far as the rubber band can possibly go before snapping back.
Which brings us to the smart money. While retail traders are liquidating their portfolios at a loss, massive institutional players are quietly stepping in to buy the fear.
Yeah, they're taking advantage of it.
Our whale-watching sources, these trackers that monitor giant crypto wallets to see where the big players are moving their money, spotted a $553,000 long position.
$500,000.
Right? Opened by a single entity on Binance Futures at exactly $8.88.
They recognize the exhaustion. In institutional trading, this phase is known as market absorption.
Market absorption, meaning they're soaking it up.
Exactly. You have all this retail sell-side pressure flooding the market, but the price mysteriously stops falling.
Because of the whales.
Right. That happens because those desperate sell orders are slamming into massive hidden buy-side limit orders placed by whales. The whales are essentially absorbing the panic, acting as a sponge to stabilize the price. It proves that the reality taking place on social media and the reality executing in the actual order books are entirely disconnected.
So these institutional whales aren't just buying blindly to be contrarians, right? They must be evaluating a completely different data set than the retail users on Twitter.
Oh, absolutely. They aren't looking at Reddit.
If they aren't counting developers, they have to be looking at real-world integration.
They are looking at what we call the invisible bull market. While retail argues over developer counts, massive enterprises are restructuring their entire technological backend on top of this network.
The list of institutions actively building on Avalanche in our 2026 sources is genuinely staggering.
It's massive.
Just yesterday, the Avalanche Payments Collective formally launched. We are talking about 28 of the largest financial organizations on the planet.
Yeah, real heavy hitters.
Giants like Franklin Templeton, Van Eck, Paxos, and Kraken partnering to build global payment infrastructures natively on Avalanche.
And we are seeing adoption move far beyond just traditional finance pilots.
Yeah, let's look at the sports world. Yeah. FIFA is deploying a custom Avalanche blockchain specifically for the 2026 World Cup tickets.
And fan loyalty programs.
Right, and their primary motivation is to entirely eradicate ticket scalping.
Which is an incredibly elegant use case for smart contracts.
How so?
Well, think about it. Instead of a paper ticket or a simple barcode that can be screenshotted and sold on a secondary market for a massive markup, the ticket is a programmable asset on the blockchain.
Okay.
FIFA can write code into the ticket itself that physically prevents it from being transferred to another wallet in exchange for more than its original face value.
That is wild. They are hard-coding the rules of commerce directly into the ticket itself.
Exactly.
And we are seeing similar tectonic shifts in Asian markets. Progmat, which is Japan's absolute largest security token platform, is currently migrating over $2 billion in real estate and corporate bonds.
From Corda, right.
Yes, migrating from their legacy system, Corda, over to a dedicated Avalanche network. And on top of that, Galaxy just tokenized a $75 million collateralized loan obligation, or CLO, anchored by Grove.
Now, a CLO, for our beginner listeners, is essentially a massive pool of corporate loans that are bundled together and sold to investors.
Right.
Traditionally, managing and settling a $75 million pool of loans requires a small army of accountants, lawyers, and days of waiting for databases to reconcile across different banks.
But by tokenizing it on a blockchain, the entire $75 million bundle becomes a single digital asset where the interest payments and ownership transfers settle automatically.
In seconds.
In seconds, without the need for human intermediaries. It's like obsessing over the paint job and the racing decals on a car, completely failing to notice that an entire team of mechanics is quietly ripping out the old combustion engine and replacing it with a nuclear reactor.
The fundamental goals of institutional adoption are just structurally different from retail hype.
They want different things.
Completely. A retail trader might buy a token hoping the price jumps 20% by next week so they can cash out. Institutions are playing a multi-decade game.
Right.
They aren't buying AVAX to flip it on a crypto exchange. They are integrating it as back-end utility infrastructure to move billions of dollars globally.
So if they don't care about a 20% speculative pump, they must be evaluating the technology purely as industrial plumbing.
Yes, plumbing is a great word for it.
They just want it to be incredibly fast, incredibly cheap, and absolutely unbreakable.
Sub-second finality is the specific metric they care about.
A finality, meaning when the transaction is done.
Exactly. Finality is the moment a transaction becomes completely irreversible. On older blockchains or even in traditional banking, you might have to wait minutes or even days for a transaction to be finalized.
Which is too slow.
Way too slow. Institutions cannot afford settlement risk. They need to know that the moment a billion-dollar bond is transferred, the transaction is finalized and permanently cemented in the ledger in less than a second.
But why Avalanche? I mean, if developers seem to be migrating to chains like Solana, what is under the hood of Avalanche that makes a behemoth like Franklin Templeton or FIFA choose this specific network over the competitors?
It comes down to a radical change in the network's underlying architecture. In 2026, the network deployed a massive fundamental upgrade called Avalanche9000.
Also known as Etna, right?
Yes, known in the developer community as Etna.
Our sources mention Etna extensively. It seems like it completely changed the identity of the network.
It did. It shifted Avalanche from being a standard general-purpose blockchain, where every single application, game, and meme coin is fighting for processing space on the same crowded highway.
Right.
It shifted it from that to an institutional-grade infrastructure of what they call sovereign layer 1.
Sovereign layer 1. So instead of forcing FIFA to share a congested highway with thousands of amateur crypto traders, FIFA gets the tools to build their own private high-speed highway.
Exactly.
And that connects directly to the broader Avalanche ecosystem.
Precisely. And crucially, the Etna upgrade dropped the deployment costs for these custom sovereign networks by over 99%.
99%? That's insane.
It's massive. Launching a dedicated enterprise blockchain went from an expensive, resource-heavy endeavor to being practically free to deploy.
That drastically lowers the barrier to entry for massive corporations. But reading through the social sentiment trackers, a specific part of this upgrade proposal, ACP77, sparked a massive wave of anger among the retail community.
Oh yeah, ACP77 was highly controversial because it fundamentally altered the staking mechanics of the network.
Let's explain staking really quickly. In a system like Avalanche, network security is maintained by validators.
Right.
Previously, if an enterprise wanted to launch their own custom chain, their validators were forced to lock up or stake 2,000 AVAX tokens just to be allowed to process transactions.
Which is a huge upfront cost.
It's essentially putting down a massive security deposit to prove you have skin in the game. but ACP77 removed that strict requirement entirely.
Wait,
Yeah, they transitioned the network to a pay-as-you-go model, where these custom layer ones just pay a tiny monthly service fee.
around 1.33 AVX, I think?
Yep, around 1.33 AVX to the primary network. Additionally, they rolled out the Granite and Octane upgrades, which slashed transaction-based fees by an incredible 96%.
From an enterprise perspective, those upgrades make the network irresistibly cheap, fast, and customizable.
I have to play devil's advocate here, though, because the retail investors seem to have a valid point.
Okay, let's hear it.
If you remove the strict requirement for every new network to lock up 2,000 tokens, doesn't that inherently destroy the token's value?
Ah,
I mean, as an investor, you want artificial scarcity. If there is less AVX locked away in a digital vault, there is vastly more supply floating around on the open market. Increased supply without increased demand pushes the price down.
that is the exact mathematical reality driving the current negative retail sentiment.
Right.
In the short term, removing the 2,000 AVAX staking requirement absolutely removes an immediate massive source of buy pressure. Enterprises no longer have to go to the open market and buy hundreds of thousands of dollars worth of tokens just to turn their software on.
So why would the developers shoot their own token price in the foot?
Because they are playing a volume game based on long-term economic strategy.
A volume game.
Yeah. By lowering that massive financial barrier to entry, Avalanche stops acting like an exclusive country club and starts acting like a global utility grid, inviting thousands of enterprises to build on their infrastructure.
Making up the lost staking revenue on sheer transaction volume.
And that volume is enhanced by the burn mechanism.
Yeah, the burn.
Right. Avalanche actually has multiple internal blockchains to handle different tasks, and the main network where the vast majority of retail and smart contract activity happens is called the C chain. When a transaction executes on the C chain, the base fee paid isn't handed over to a miner or validator to be sold back onto the open market. It is permanently destroyed, burned out the total supply forever.
So having a handful of enterprises locking up 2,000 tokens is good, but having thousands of custom networks executing hundreds of millions of transactions, burning a tiny fraction of a token every single time a ticket is scanned or the bond is settled.
Yeah, that creates a far more aggressive, sustainable, deflationary pressure on the total supply over the next 10 years.
It entirely rewires the economic engine of the asset.
It really does.
This brings us back to the core dilemma for a beginner listener trying to navigate this space. How do you actually weigh this information?
It's tough.
We have this extreme disconnect. Social media is screaming that the network is dead because amateur developers are leaving, while traditional finance is quietly migrating billions of dollars of real-world value onto the network because the architecture is finally scalable enough to use.
The most practical way to view this is recognizing that AVX currently possesses a dual valuation profile.
Dual valuation.
Yeah, it is essentially an asset being judged by two entirely different rulebooks simultaneously.
One rulebook for the short-term traders and one for the long-term builders.
Exactly. In the short term, retail sentiment and macroeconomic trends completely control the steering wheel. We are talking about the negative ETF flows across the broader crypto market, high interest rates from central banks, and yes, the daily narratings on Twitter.
Right.
This creates a profile known in finance as high beta.
Meaning the asset experiences significantly more violent price swings and volatility compared to the broader, more stable market.
Yes. It is highly reactive, cyclical volatility. That is the rulebook that explains why the price can aggressively swing from $35 down to $6 based on fear.
But the long-term rulebook relies on entirely different metrics. When you read reports projecting a path to $100 by 2030, those analysts are entirely ignoring Twitter likes.
Totally ignoring them.
They're tracking sustained TVL, total value locked.
TVL being the aggregate dollar amount of actual capital deposited and actively functioning within the network's smart contracts. A healthy network needs a TVL crossing $15 billion.
And they are watching the steady increase in deployed sovereign layer ones, which currently sits at 497.
Almost 500 custom enterprise networks running seamlessly on Avalanche infrastructure.
And they are tracking raw processing volume. Our sources indicate the C-chain alone processed over 220.9 million transactions in just the first quarter of 2026.
And returning to the tokenomics, every single one of those 220 million transactions burned a tiny bit of the supply.
Because of that burn mechanism we talked about.
Right. It is vital to remember that AVAX has a strict hard-cap supply of 720 million tokens. The code dictates they can never print more than that.
Okay.
And through sheer network usage, over 5.4 million of those tokens have already been permanently burned out of existence.
So synthesizing all this down to a practical takeaway for you, the listener, should a beginner investor just train themselves to ignore social media entirely? Like, delete X, close Reddit, and spend all their time exclusively reading dense institutional white papers?
Well, no. Balance is essential. Social sentiment is highly valuable, provided you understand what it is actually measuring.
Which is?
It is a perfect thermometer for short-term market psychology. As we discussed earlier, identifying an extreme FUD phase where retail is panicking is a brilliant tool for spotting contrarian buying opportunities.
It basically tells you when the sellers have completely exhausted themselves.
But for long-term thesis building, if you are trying to project where a specific technology will be in 5 or 10 years, you must look under the hood.
Right.
Social media tells you how the crowd is feeling today. On-chain data and architectural upgrades tell you what the institutions are building for tomorrow.
The ultimate lesson from our stack of 2026 data is that social sentiment in crypto is often just a noisy, highly emotional surface layer. Avalanche is the perfect case study. Retail investors are selling at a loss because of developer headcounts, while Japan's biggest banks and global sporting organizations are quietly laying the digital groundwork for the next generation of global settlement.
Yeah, it's wild.
Understanding that tension is the difference between blindly following the crowd and actually understanding the market.
Which leaves us with a truly fascinating, larger question to consider regarding the future of this entire industry.
Oh, lay it on me.
We've spent this time analyzing how legacy financial institutions are adopting this technology specifically for mundane tasks, settling corporate bonds, verifying World Cup tickets, managing loan obligations.
The boring stuff.
Exactly. If traditional finance fully adopts blockchain simply as a hyper-efficient back-end settlement layer, if it just becomes the invisible plumbing of the modern internet, will future cryptocurrency valuations eventually decouple from retail speculation entirely? We could be witnessing the moment where tokens like AVX transition from being speculative internet money driven by social media hype into boring, invisible infrastructure commodities.
That is a crazy thought.
Imagine a future where using crypto is exactly like buying cloud computing credits from Amazon Web Services. The everyday fan buying a soccer ticket won't even realize they are interacting with the blockchain.
Because it's just happening in the background.
Exactly. And when the tech becomes that invisible, the noisy opinions of social media traders won't dictate the market ever again.